You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time once again for the option block, everyone's favorite. I know it's my favorite bi-weekly source for all things options related. A little bit of options wit, a little bit of options wisdom, some analysis, some education, throw in some unusual activity, a sprinkling, a smattering of some strategy/education, and then a dash of your questions. And that makes the heady brew, the delicious cocktail that is the option block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Back in the old mothership, the flagship, for all of you out there who were wondering, hey, where were they last week? Where was the live show? Well, we were off gallivanting. We were off at the Risk Management Conference down there in scenic and sunny Florida. Thankfully, the boys back here, the Rock Lobster and Uncle Mike, held down the fort admirably and did an admirable job for us as we were gallivanting around not the globe so much, but the country. It is indeed conference season. In fact, I'll be gallivanting again next week and a few weeks after that. So all the conferences seem to spring up this time of year in the old options and derivatives world. But we try to bring you all the fun content from those conferences. So stay tuned to the site and indeed to the network for a lot of fun stuff coming from this show, RMC, as well as some future upcoming programs. And of course, while you're on the site, Insider Radio Network tab, top left corner of the page is where your audio adventure begins. All of our programs are there, including all of our 500 plus archived episodes of this here fine program, The Option Block. And of course, you guys out there in the realm of Mixlr and using the app can also follow us live over there via the Mixlr app as well, MIXLR. We always tweet out the link, and we put it out via Facebook and other platforms as well. So if you're following us over there on social media at Options, probably the easiest place to find us, you'll see the link go out. And we're going to try to keep it to a Monday and Thursday at 3 p.m. Central, 4 p.m. Eastern for the option block, Friday, noon Central, 1 p.m. Eastern for vol views. That said, conference season throws a bit of a wrench into those works, so we're not sure if we're going to be able to keep the schedule for next week, but at least for this week, we'll be live and coming at you on all the platforms you guys like. And joining me for this live extravaganza is the aforementioned Mr. Rock Lobster himself, Senior Andrew Giovinazzi, the man, the major domo over there in the realm of the option pit. Mr. G, welcome back to the program, and well done last week, sir, dealing with all of the myriad different things thrown at you throughout the course of the week.
Yeah, you had a lot going on.
We're busy.
Oh, I'm sorry, but you were doing it all in Florida. So it was, and I'm not a conspiracy theory guy, but maybe Tosaw could help me out with this. How come it's all of the conferences basically are in Florida or California when it's sort of the end of winter on the East Coast? Is there not a conspiracy theorist, just wondering why that is? Let's just say if you were randomly trying to think about it.
It is funny how that works.
Forget Vegas.
Oh yeah, because that's not a vacation spot. That's a serious place. You do serious stuff in Vegas.
It is funny how that always works. I always joke about that too. You don't see a lot of conferences in Minnesota in January or anything along those lines. Funny how they all tend to drift south for the winter. So yeah, I'll be heading back down to Florida. Usually the FIA and the RMC conferences are back to back, so I can kind of do them in one fell swoop. This time, not so much. Have to do them separate trips, but c'est la vie. It is my lot in life to have to go down to Florida multiple times. Your counterpart there, your better half or worst half, depending on your viewpoint over there, Mr. Greasy Meatball, was also down at the RMC conference. We did a great breakdown of all things RMC, so check it out on the old site if you are indeed so inclined. Meanwhile, we're going to keep on rocking and rolling with this here program and get right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
I just realized before we even did that, Uncle Mike chimed in, but I didn't get a chance to really introduce him. So we're also joined by Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome to the Trading Block. A little bit late, better late than never, though, sir.
Well, allow me to claim umbrage 7 minutes into the show. But thank you. It's always good to be here.
It's always good to have the early umbrage out of the way, so we can get rolling with the program that is, and this is indeed the Trading Block, listeners, the portion of the show where we break down what was moving, what was shaking, what caught our eye in today's activity. A lot going on, even though at the end of the day here, most of the major indices kind of mixed on the day. The S&P, as we're recording this right around 3 p.m. Central here, pretty much almost literally unched off about a handle or so. The Dow up slightly. The NASDAQ off a little bit more, off about 0.6 of a percentage point or so. And all of this downside means VIX cash taking a little bit of an inhale this week after taking a big drubbing at the tail end of last week. We'll get to it in a little bit, but we had a poll last week on our options question of the week. We asked a lot of our listeners where they thought the VIX cash was going to end up, and let's just say the lion's share of our listeners out there thought it was going to be well north of the 20 handle. In fact, I'll just break it down for you. As it closed, about a third, the leading number as the poll closed, the question was, where's VIX cash going to close last Friday, on March 4th? And what won was between 22.5 and 25. That got about a third of the votes. 17% said about between 20 and 22.5. So they were a little bit closer. About a quarter said below 20, so a quarter were leaning in that range, and then a little bit more than a quarter said above 25. So about 3/4 of them respondents or so really leaning north of the 20 handle. Did have one eerily prescient response from one of our regular listeners. I think it was Mr. Mark B., who writes in a lot to the show and others. He wrote in with 17.34. Early in the week, so he was pretty spot on as far as where VIX cash ended up. Actually, as we're recording this right now, it's hovering at 17.36. So he was eerily close. I believe the high was 17.35 and it closed at the 16.86. So he kind of gets the closest of the week award. He's the only one who gave it an actual specific number, and again, an eerily specific number. So a lot going on last week and a lot going on this week. Let's start off with today's activity. Mr. Rock Lobster, you did such an able job managing the show last week. I'll give you pride of place. What caught your eye in today's activity, sir?
You know, it's the continual squeeze in commodities and oils. We covered it as a topic last week. I've been looking at our chat room for the last 2 weeks, just real, like somebody blew the all clear whistle or the squeeze whistle or something, and I don't know who did it, but maybe it's kind of the preponderance of negative rates. I guess Japan negative. I think there's some random Scandinavian country with a negative interest rates. Now Draghi might do the negative. Like, what? I mean, the thing is they're not even in a recession. So and they're, so there's some short covering in some of those items. So there was so much poor sentiment in commodities, oil, and things like that. And I just think there's a short covering rally. I don't know how long it's going to last. It looks like there's a lot of hard to borrow issues and stuff like that, all the names, but it's happened, yet again for another day. All those names, all the oil producers, things like that, just keep rallying. So very, very, very interesting and strange activity. That's what I'm going to say there.
Once we started talking about going negative over here in the States, that's what all the cool kids started talking about. So now overseas, they all want to get into the negative rates party because it's just where the cool kids are right now. When you're talking about central banks and lending and everything else, all the cool hip kids are flirting with the dangerous realm of negative rates. And so that's why everyone seems to be coming lately to that party, Mr. Rock Lobster. That's what all the hip cats are up to these days. Speaking of hip cats, Mr. Uncle Mike, the hippest of hip lands out there, St. Charles, Illinois. Your brochure still on my desk, by the way, so we'll have to plan a nice sojourn out to St. Charles one of these days. But in addition to the lovely scenic destination that is St. Charles, what caught your eye in today's activity, sir?
Well, with the breathtaking views of St. Charles, it's hard for anything else to catch my eye. But because I love this show so much, I do turn my eyes away momentarily to look at the markets. With that being said, I was kind of hoping it would be a Prince market again today, to where I could say we closed at 1999, but unfortunately the S&P was at 2001 at the close. But nonetheless, it was close. Gold is catching my eye. It's continuing to rally, especially with last week. Today it didn't rally so much, but I am selling. I did sell some puts today to kind of get a little bit of a position in it, to where right now I have a 25 delta put option. It's the 117 April week 2 put, just because I got to get some type of exposure to this market, because I can't let it totally get away from me. But on the flip side, if it pulls back, I don't want to get left totally holding the bag. But gold caught my eye a little bit today. But the main thing that's really catching my eye right now today in this marketplace is that this whole year there's always been talk of, well, if oil comes up, then the market's going to come back. Not necessarily by us on this show, but that has been a popular theme throughout the financial media this year. Well, oil's up $2 on the day, XLE is up over 2% on the day, and the market's flat. So I think that we might be, that's one of two things. Either this market might be a little bit overbought just with the massive rally that we've had over the course of the last week or two, or this thing about buying oil closer to the bottom, like it may be right now, that might be for real. So those are the two main facts that I saw today that really caught my eyes. The fact that oil had a really big day today, oil stocks had a really big day today, and the S&P was flat.
Yeah, you're right. That kind of has been the narrative for the better part of this year. That, once, it's so funny how the narrative shifts. A year and a half ago or so was oil is too expensive. It's going to weigh down the market. Now here we are, oil is too cheap. And we're seeing all the myriad other side effects of that. All the banks that got caught up in extending and leveraging themselves to lend to these energy firms now getting bit by that, and a lot of other things. Even though, of course, as you said before in the show, the consumer and user benefits to this have been demonstrable. People have a little bit more money in their pocket. That tends to accrete throughout the economy. So there's a bit of a push and pull there. But you're right. The net narrative has been when oil turns around, and it's still debatable whether the turnaround has happened. So far it's rallying right now, but we've seen these kind of ill-fated rallies before in the name. We'll have to really take a deep dive maybe on a future episode into some of the term structure out there to see what people are loading up on in the realm of crude via the old platforms that we like to use out there. And by the way, speaking of platforms, if you are listening live, we do like to hear your questions and comments. You can, of course, chat along with us in the chat room. A lot of you, for some reason, don't have or don't want to make a new account. I understand that. So you don't want to make a Mixlr account. Then you can just hit us up via the other platforms, Twitter, Facebook, etc. And we'll see if we can get them included in the show in time for the recording here. Speaking of the recordings and what we were talking about, we recorded a lot from the Risk Management Conference last week. That was the big CBOE annual event there where they look at all things volatility-oriented, hedging-oriented, and how a lot of institutional end users, pension funds, etc., can and should be using a lot of these products, as well as how they actually use them in real life. And there were a couple interesting takeaways I kind of wanted to share with our audience here. If you want our full breakdown, like I said, if you want our full breakdown of all the highlights of RMC, then go check out the episode that Mark and myself and Russell Rhodes did from the conference last week. I hit our feed live this morning. Subscribe to Volatility Views if you haven't done so already. You can check it out there, or you can get it all via our main radio network feed that has all the shows in there, and that has a full hour-long breakdown of all of the interesting and some controversial highlights from the conference. I'll just hit a few salient points here. One of the main takeaways, and we touched on this a little bit going into the conference, became even stronger during the conference, was essentially just sell puts and sell them all the time. That was kind of one of the inescapable conclusions of the overwhelming amount of data they put forward. Of course, there was the weekly put right study going into the conference, weeklies versus regular put right, and of course the same data with Russell showing the weekly versus the monthly put right, writing weekly puts orders of magnitude better from a net aggregate premium perspective. They got into the conference itself. We saw studies coming out of Goldman and others about the efficacy of put writing and various methodology for how to do it. Again, breaking down the weekly versus the monthly as well. Some people, the Goldman guy, getting into some models like choosing your strike price via the free cash flow yield of that name and a few others, and the efficacy of that approach versus others. But at the end, the net aggregate fire hose of data coming out of RMC said pretty much sell puts and sell them often. So that was kind of interesting. I haven't really come away from that conference with that takeaway in years past. So that was something a little bit different. There also were some new spins on the age-old debate of the VIX call versus SPX put when it comes down to which is the more effective tool for hedging or for whatever you want it to be. We've debated on this show whether we kind of think which one really is a hedge, which one isn't. We tend to come down on the side of the SPX put, and that usually is the winner. At this conference, they sometimes go through some interesting, hoops to see different ways and methodologies you can make the VIX call more effective in that comparison. And surprise, surprise, they came down with two recommendations that they found to be very effective uses for the VIX call, make it more effective and actually outperform the SPX put. One of them was our old friend, we talked about it a lot on Volatility Views, is essentially that short 1/2 ratio vertical in the VIX calls. We saw that going up for size last year, pretty much rolling it for about 6 months till that guy really hit it out of the park, where he was selling one, buying two, doing it for about 1 million or so contracts a month as he continued to roll. Really knocked it out of the park in August, and he kind of backed off that strategy. Not that he had to keep doing it. He made a ton off doing that. That strategy really works, and it worked pretty well throughout the lion's share of 2015. All the data showed, particularly where we had those extreme backward moments, that strategy really did well. Not really surprising. And the other one they kind of broke down with was a VIX 3-month call spread. That seems to be kind of, I've seen other data on that as well, kind of showing that you have to really do some interesting, funky calendars to make the VIX call work out pretty well. And this one study, again, I don't have the data points, all of them in front of me, but they found about a 3-month calendar spread. I forgot the exact percentage out of the money, also made the VIX call outperform versus the SPX put. Remember, when you're talking the VIX call, it's all about kind of table stakes management like you would in a casino. You kind of have to really make that call hold out for you till the moment. You have to kind of survive until the moment where you can capture those extreme outperformance moments to the upside. That's what that short 1/2 does really well, and the VIX calendar can do in a certain number of environments. So there's a lot of debate on which was the most effective way to structure those different types of trades. Also has some interesting panels on how hedge fund and pension fund managers use or frequently don't use options. There's a lot of interesting talk about that. There were some consultants down there talking about how they advocate for a lot of these pension funds to start using options and the pushback they get from those funds when you mention anything derivatives, which is always a frequent pushback. And they were trying to get these funds to, a lot of times they'll get funds to agree to do these, dip their toes in the waters and do a small, 2% alts allocation to some sort of options overlay. And they always say, that's not going to move the needle for you at all. You got to be at least 10, preferably 20% to really do something of value. And they're saying they're starting to see some funds actually willing to allocate half of their equity portfolios to some sort of overlay or hedging strategy. And that's really shown some demonstrable benefits. So they're having some success getting these funds to start increasingly allocating larger percentages to options-oriented strategies. They're also still getting this mindset from a lot of the fund managers that, hey, I'm all right if I lose money on my stock selection, but you guys can't lose money on your options allocation to me. So that's always a challenge, particularly if you're coming to them with some sort of hedging strategy, which is going to lose money if it works well. So there's some challenge on the mindset there. And that was a lot of other cool stuff, a lot of other great data talking about basis points, how much it costs to buy tail risk and whether you should do it, whether you shouldn't do it. And a lot of interesting data points from that. Again, if you want to go deep into that stuff, check out the deep dive from VALE Views that went up this morning, and you can get a full hour plus of a really deep dive and some interesting debate back and forth from us on the different points we found that were interesting, some that were not so interesting, some different viewpoints on that one, which was kind of fun. I don't know, Andrew or Mike, you guys, do you get a chance to pay any attention from any of the updates coming out of the conference? Anything catch your eye from last week?
Not in addition to what you said.
No, go ahead, Mike.
Oh, no, I was just going to say that just with what you had said, Mark, that is a lot of interesting factual things that go on there. And anytime you can go to something like that, I think it's a wonderful thing to do.
Yeah, it's fun to just kind of get the lay of the land when it comes to research and all these fun kind of things. Speaking of research, our friends over there at Goldman have been busy. They put out another one of their seminal research notes. I'm sure you saw this one, Mr. Rock Lobster. This time they're coming out with our friends over there at Bloomberg, saying this is the best time to buy bullish options on the SPX in 20 years. They make some of these kind of histrionic calls in the past. Probably the most infamous one recently was, I believe it was back out last October and November, when they said everyone had to load up on volatility out there in the crude oil products, in particular downside volatility. That didn't work out overwhelmingly well from a vol perspective. Net underlying move, it kind of worked out if you were able to roll successively. You may have done all right. Maybe broke even on the underlying moving your way eventually. But in the initial months after the release, that certainly the buying of vol was not a winning trade out there in crude oil land, as vol kind of just eroded for the subsequent months going into the end of the year. Now they're coming out and saying, they say S&P has a 21% probability of gapping up 5% in the next month. They're saying the options market only pricing in about a 5% chance for just that. So this kind of caught my eye for a couple of reasons. Of course, S&P in rally mode right now, up about 9.3% since it bottomed out at a 2-year low last month. So certainly the bulls are in charge, at least for the time being. But it's very rare, Andrew, that we see a bank like Goldman coming out with such a broad and far-reaching thing like this, coming out and essentially just saying, hey, just buy calls in S&P, not saying buy verticals or anything else that has a little bit better payout perspective. So what's your call on our friends here at Goldman making this kind of broad call to just load up on some upside out in the S&P? What's the worst that can happen, right?
Well, you could lose all your money on the calls.
No, that doesn't happen. You're telling me lies, sir.
I find it interesting, but I think, and it's kind of something, I don't know, we've been doing a variation of that, but just they're looking at it, they're like, well, you know what? Implied vol seems kind of cheap relative. I think implied volatility feels relatively cheap, and the market's still moving a lot. And generally, the VIX volatility gets crushed when we have these huge rallies. And there's just not a lot of options are not very expensive for the type of activity we're seeing, I think. So it is I don't think it's a crazy call. It's, they were close on their $20 pin in oil. What do we get to 27 or 26? So that wasn't too bad. You never know, but it looks like it doesn't look totally not possible.
Doesn't look totally not possible. That's damning with faint praise, sir. Uncle Mike, you're our resident bull. What's your take on this upside love coming from Goldman?
Well, I think it also has to do with their market sentiment, because of the fact that just based on VIX, it's obviously not the best time in 20 years to buy calls. The VIX is still over the 17 level right now, and we've had it much lower just as recent as, this past few months, quite honestly. So they're bullish on the market itself, and I think that their bullishness on the market is outweighing their thought on why you should buy calls. So in other words, you have talked about on the show many times how sometimes you see a guy at the crap table just making money off of those exotic side bets, just being totally lucky. Well, I think this is kind of along those lines, in that they're using their market sentiment to determine what you should do in the options realm. I personally don't think it's near as good of a call buying market as it was several months ago with the VIX much lower. So with that, if they're bullish on the marketplace, who am I to judge? But I think it's more based upon their market sentiment than on their option strategy selection.
Yeah, they probably lead with the sentiment first, and then they find a strategy they feel will work for that. But you're right, not perhaps optimized from a vol perspective. Really quickly, it is the tail end of earnings season. We do have one earnings, a couple coming out after the close. We'll just focus on one mega market mover. That is, of course, Shake Shack. Everyone sets their watch by how Shake Shack performs. I know this is one of the Greasy Meatballs' favorites over there, and closed today about 42.25 or so, up about 0.6%. That at the money straddle going out right around 450 was almost about 11% move that they were baking in, and here we are in the after hours. The name's off about $3.13, so nearly 7.5% here in the after hours. So it seems like all you Shake Shack premium lovers, at least for the time being, it is underperforming. We'll keep an eye on that one, but again, kind of dipping into the dregs of the barrel there as when it comes to earnings. The season pretty much having wound down already, but we're not done, not by a long shot, listeners. It's time for us to keep on rolling right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block, the funky portion of the show where we break down the weird, the wild, the whimsical, sometimes just downright head-scratching paper that we're seeing lighten up the old options market today. Going to kick things off, talking about earnings. This is the name that usually kicks off the season. It's Alcoa, ticker symbol AA, closing today $10.04, up a whopping 5% on the day. So not a bad day for good old Alcoa. And what caught our eye out there, given this extended upside out here, were some interesting call verticals. Before we even get to that, this is a name that averages about 55,000 contracts a day, so they do some fairly decent paper. Certainly pretty strong from an odd block perspective. Today, doing over 3x that, about 160 some odd thousand contracts going up out there today. So pretty aggressive paper from an Alcoa perspective, about 2-to-1 calls over puts, so wee bit of a call bias out there, and that's kind of what caught our eye out here was what looks like to be a bit of a call roll. Got to go all the way out there to the July expiration cycle, listeners, to find our perpetrator in particular. It was the July 8-11 vertical that went up. We started noticing this going up in 2 blocks on the Philly, totaling 15,000 contracts, going up for effectively $2, $2.67 on the 8 calls, 67 cents on the 11 calls, going up, paper selling the 8s, buying the 11s. As the day went on, we saw more size to the tune of a total of about 35,000 of these bad boys going up total. Size open interest on both of these strikes, 106,000 going up on the, open on the 8 strike, about 53,000 on the 11 strike. So these are pretty much the 2 sizable strikes open around on July. Nothing else even close, pretty much on the call side for sure. So interesting that these spreads are going up. It seems like it's a roll. Looks like a bit of a house money roll too, given the performance of Alcoa over the past few months. Looking at a chart of Alcoa over the past year, certainly over the past few months, it's been pretty much a straight upward shot ever since the middle of January when this thing was trading down about 6.5. This thing's up about $3.50 from there. So up pretty aggressively. Our friend here probably pretty happy with how his 8 calls have performed, but he's not going away. He said, no, I'm just going to keep reestablishing here on the 11 strike. Or perhaps the converse there, he could be closing on both, given the fact there is so much size open interest. We'll turn our attention now to the Rock Lobster, who first noticed this size vertical going up. Mr. Rock Lobster, what's your take here? Rolling with house money, or you think perhaps close, because there's just so much going on both these strikes?
That was, what, we saw some volume going up before. It looked like there was a ton of volume on that 8 strike, and they started rolling the 8 to the 11. I got to look at the volume tomorrow to make sure, but it sure looked like a house money roll going up because we had that crazy rally. So the only problem is the price they got for the spread was really good. Generally means when, it was almost like a perfect, isn't this aggravating? You're a market maker, 50,000 spreads go up, they're totally at fair value. So maybe somebody wanted to make the sale, so I have to check tomorrow to see. But, if they were, or either way, or they're covering their 8s and then selling 11s. Because again, it's in a weird, again, we're up at strange prices. But if they're covering their 8s and selling 11s, that means they don't expect the underlying to go back down either. So I think either way, just the way that thing is set up, it's a bullish type of sentiment spread one way or the other.
And we got Jerry Pena firing in from the chat room saying, he says the 9 puts were active too. I'm not sure, he doesn't say which ones. I'm looking at the March 9s did about 7,000 contracts. The weekly's 9s also doing about 8,000 contracts out there. So there was some life. And then in June, there looks like a bit of an 8-10 put vertical going out there. I don't see any 9 puts going up in July. And he also says, maybe this has something to do with it. He says, Alcoa closed above its 200-day moving average. So all of you technicians out there perhaps agree with his sentiment. Maybe that's why our friend kept the top leg rolling and didn't just close it out. He figures maybe either way, he feels there's more upside to be had here for good old Alcoa. As we move on into our next name, you can't talk the markets today without talking something energy related. Today we're going to have, I think this is a newcomer to the odd block. I don't recall talking about this one, at least not for some time. This is Linn Energy LLC, ticker symbol LINE. Closing today. This is our resident cheapie for you. If the other name, $10, was too rich for your blood, we got you covered. This one closing today, up 95 cents. To a whopping $1.95. So yeah, pretty much doubled in the day today. So that should give you some idea what the heck was going on out in this name. This name usually does, about 4,000 contracts a day, doing well over 10x that today, doing 46,000 contracts, about 3.1 to 1 calls over puts. Yet, despite all that all that call love, it was the puts that caught our eye out here. In particular, the April, I love saying these strikes, Mr. Rock Lobster, the April 1/2, yes, $1.50 puts going up. When we first noticed these, about 1,211 times. Paper buying looks like they're closing out a short here for about 55 cents. As the day went on, total of about 5,000 went up on that name. Paper buying at different levels. But a total of about 5,000 going up on this name. Not surprisingly, you got a name that's pretty much doubled. Our friend taking his short puts off the table. The initial kind went up in one block over there on the Philly as a sweep. This open interest, it's been hanging around for a bit. Our friend's been waiting for this moment here. He drew an aggressive line in the sand around 1/2, and until this morning, that was in the money. So he was playing with a little bit of fire there, and now he's deciding discretion is the better part of valor. Mr. Rock Lobster, what's your take on our friend here, closing out those oh-so-dangerous 1/2 puts in line?
Well, we were just reading about this was one of a list of, 50 stocks or 100 stocks that, they can't make their interest payments. They're, ready to file going concern paperwork because just their whole business went belly up, and they did an expensive buyout about 1.5 years ago. So just bad timing all the way around. But anyway, apparently the stock isn't going to zero, and the equity might be worth something. Quite maybe not. I have no idea. But what's funny is I was looking at these puts, and the market on the day before, even with the stock went up basically 100%, the puts barely went down because the thing's so hard to borrow. The volatility is, kind of sideways. But I think maybe somebody got maybe $1.50 for them, and or whatever they got for them. I think the straddle's trading. The straddle is worth more than the stock is, I believe, if you looked on a couple of the prices on the strikes on some of them. So I think they're taking their short puts and hitting the road. They might have clipped 25 or 30 cents out of it if they got a good sale on the puts. I think because at some point they were ridiculous. The 1.5 puts for $1 or something. They're just, what are you going to do? It was a 40-cent stock.
Yeah, he was sweating these ones, and he's getting the hell out of Dodge today. He's like, woo. He can stop popping those Tums, and
I'm done.
The risk manager can stop tapping him on the shoulder. When are you going to get all those puts? He did it today. He's got a smile on his face. As we move up, Jerry also commenting about line. Yeah, it's up quite a bit today. Pretty aggressive day. Makes for a good options day as we move on into our final name here in the odd block. This is an old friend. I haven't talked about it in a little while, but we can't close out today without touching a little bit on metals and mining. Gold wasn't top of mind for a lot of people today, but it has been rocking and rolling over the past few weeks. This is VALE SA. This is an ADR. Ticker symbol VALE, VALE, closing today, $4.65, up about 6.2%. This is the name that does, about 23,000 contracts a day. Doing a fair bit more than that today, doing about 120,000 calls today, 120,000 contracts today. And what caught our eye came on the call side. In particular, it was the April. Everyone loves April these days. It was the April 5/2 going up paper buying. It first caught our eye in a mega block of 29,400 paper buy-in for about 30 cents. As the day went on, a total of 44,474 went up on this strike, and it's all opening. The later kind actually lifting the offer 29 cents and then 30 cents for the rest. So gobbling these bad boys up. It's all opening. How do we know that? Well, a whopping 96 contracts open on the strike right now. So someone's loving themselves some VALE. Looking here, taking a little bit of a deep dive. No stock going up to speak of. So it seems like this is pretty much what it appears to be on the surface. A straight up upside love on the 5/2 to 580 or so range, depending on where he's buying these suckers. Looking at a 1 year chart of good old VALE. We talked about this one before on the old odd block. They peaked right around last May or so in like the $9 or so range. Our friend here, even though it has been on the tier over the past month, has gained about $1.60 or so. Just over the past month alone, so about a third. Actually half of its value in the past month or so. Our friend here thinking the upside run is not done, and he's putting his money where his mouth is to the tune of nearly 50,000 contracts on the upside. Mr. Rocklofter, take us home. What's your take on this mega call by Palooza here in VALE?
It's more of the same. We've been. It's like all people are declaring it. The commodities are going to go boom again, or the short interest in these things are going to get squeezed. I don't know if it's going to be the biggest engineered short squeeze for an entire sector of the economy, but somebody's right. Somebody's getting on the wave. That's all I know. That's $1.2 million and out of the money premium. Go get them.
Yeah, what's the worst that could happen there? It's like buying the upside calls with Goldman. What's the worst that could happen, right?
I know. It just is, and I mean, Brazil, I think the whole economy, because the news in there is so bad with corruption and this or whatever. I mean, that market is down, 65 or 70% from its all-time highs. So, I think it's looking for a value. It looks like a stock that's ready to, pop again. It was 2, now it's 4. And I think a lot of the recent sell-off in it, through January and February, just it was just poor sentiment in commodities. None of that stuff is ever going to move again. And I probably got oversold, and there's a heavy short interest in it. And if they start to cover a little bit more aggressively, they're looking for upside. And at least just from a straight momentum play, I definitely would not want to get in the way of it. I'd rather buy them and sell them if I had to choose on that particular strike.
Yeah, I guess if you had to lean some way with this thing massively moving to the upside, I guess if I had to take some upside versus sell those, yeah, that's I think that'll make my risk manager tap me on the shoulder less. So I'll go with that.
Yes.
All right. Speaking of tapping you on the shoulder, Uncle Mike's tapping me right now saying, hey, when's it my turn? So it is Monday. It's time for some strategery. So without further ado, it's time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, everybody, like the man said, it's time for Uncle Mike to don his slippers and his smoking jacket and to head on down to the old roaring fireplace. It's all faux, though, because we all know everything is temperate and beautiful all the time, 24/7, 365 out there in the land of St. Charles, Illinois. Uncle Mike, what options, wit, and or wisdom do you have on the docket for us today, sir?
Well, I want to go over what if you get out of something and it keeps going your way after you get out of it and you want to get back into it, but you missed some of it. What on earth is a trader to do?
I don't know what you're talking about. It's never happened to me, sir.
No, not at all. So with that, I want to go through, this is something that I'm doing with gold right now. And beginning of the year, I made the point to where, well, if we go below 100 in GLD, I just want to get out of this. So I'm not even going to bother putting on a put hedge. I just have a stop loss in place, and I'll probably get stopped out within the first couple of weeks or first couple of days, I was kind of thinking. And then we'll regroup from there. But, well, that never happened. Gold just shot up to the levels that it's at right now. And so with that, I actually was trailing the stop, meaning I was just moving up my stop loss as gold would go higher because, well, quite frankly, I didn't want to give up a 15% gain over the course of the last month and a half. So with that, I eventually did get stopped out of gold at the 114.92 level, I believe it was, GLD, I should say. And so I wanted to wait and see if we could close above the 120 level before I got back into it and would become a believer, so to speak. Now, if I were to get back into it, I would want to do it with not my full position, because the last thing that I need is to have GLD go from 120 back down to 115 and then 104, let's say. And I'm sorry, from 120 down to 104. And then all of a sudden, where I would have been at a 3% gain on the year, I'm now at a loss. That's not what I wanted to do. Nobody does. So what's a way with which you can get back into something when you think there is more upside, but you already got stopped out? So with gold doing what it's doing at this point, what I decided to do, the first thing I was thinking of is perhaps putting on a half position in GLD. So for every 100 shares, just buy 50, perhaps do that. And then if gold continues to go higher, well, at least I got half the rally. But if it goes down, then I can just get back in at a lower level and kind of dollar cost average my way back in. That was one thought with which I had. I thought about doing that on various levels, like maybe do 25% in here. Then, there's a lot of different things with which I thought of. But what I ultimately went with is I sold a 117 put for 4 weeks from now. And what that does is I sold the April week 2 117 put. GLD's at 121 right now as the market closed today. And what that does is that does still give me some skin in the game. It's about a 25 delta on this. And let's say that we actually go down to the 117 level. By doing it that way, I can actually get paid to get in at the 117 level. Now, I took in a credit of about $1.16, I believe it was. And so by doing this, that means that if I do get back into it, then it's like me getting out at 116 and getting back in at 117. I would have missed $1 of the upside rally, so to speak. Now, granted, if we do go down to the 117 level real quickly, I'll probably just get out of it right away. However, we'll see. I'm sorry, I'll just roll it down right away. However, we'll cross that bridge when we come to it. So what I would recommend doing if you did get a run up in something and you want to get back into it, be creative on how you want to do things. I've thought of a lot of different ways, but in this specific situation, because of the fact that I would really like to be back in gold again around the 112, 111 level with a full position, I really felt that this was my best choice at this time because if we start to go down, I can roll it down and we'll have a full position if it does go lower. But if it does go higher, I won't be left out in the cold totally. And that is the strategy block for today.
And we all know you're never left out in the cold in St. Charles because it's always beautiful. Unless you're talking from an internet perspective, then you may indeed be using the old 2 pieces of string and tin cans to talk to each other as the internet. Not the strength of the St. Charles community, shall we say. All right, and we got a little bit of time on this Monday episode, so we'll add in a special listener mail section to have you guys get your voices heard on the old program as well.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, welcome to the Mail Block. You guys know the drill. If you want to participate on the old Mail Block, well, we have the new wrinkle now, like our friend Jerry and some others have been using in recent weeks. You can hit us up live via the Mixlr chat room, or hit us up if you're listening live, but you can't use that chat for whatever reason. Hit us up via Facebook or via Twitter, etc. And if it comes into time, we'll try to answer it here on the old program. Speaking of Twitter, we have our Twitter question of the week live again. If you're not following us, just @ options on Twitter. Pretty easy to find, a pretty easy handle to remember. We kicked it off this week because there still is some noise over that looming potential banning effectively of options in IRAs by the Department of Labor. If this exemption goes through, we should know more by March. It seemed like that may be off the table. Now it seems like it may be back on, despite the fact that there's near unanimous opposition to that proposal by pretty much everyone in the industry. That seems like that may indeed be coming to pass. So we thought we'd ask our listeners, with the options ban looming, how do you guys like to use options in your IRA? We gave them the choice of income generation, downside protection, speculation, or I don't use them in my IRA. Mr. Rock Lobster, I'll give you pride of place. What do you think is winning? It's only been up for a few hours so far. What do you think is winning in the early hours here?
First off, I have to say that's the stupidest thing ever.
Yes, it is, isn't it? Why let people mitigate their risk in their IRA? Oh, I don't know. What's the point of that? What's the benefit of that?
I want to just buy I want to buy a put, and you can't.
You can't buy a put to hedge your stock, because what fun would that be?
You just got to lose all your money.
Yes, exactly.
And you got to like it.
Exactly.
It is the only. There's not much else I can say about that. So
you can thank the Department of Labor for that
favorite one. I'm going to say I'll just go with mitigating risk and buying puts.
Really interesting. That's perhaps the one you want to be winning. Uncle Mike, where are you leaning, sir?
I'm going to go with generating income, but if I were to answer it, I would say all of the above.
I don't think we have an all of the above. I thought about putting that in there because some people like to use collars and stuff, and that's kind of a little bit of both. So I thought about putting that in there, but there was only space for 4. So I didn't. At the last minute, I didn't put that in there. But yeah, the winner right now with nearly 60% of the votes is income generation. It's kind of how I thought it would break down. Only 7% saying they buy a put in their IRA. So maybe the Department of Labor is onto something there. I don't know. 15% say speculation. That could be anything. Maybe just using it to swap out for a stock to rally, or buying calls on a name you like, that sort of thing. And nearly 20%, a surprisingly large number, particularly for our audience, which is mostly options, people in the options camp, say they don't use them in their IRA. So that kind of surprised me. Again, that's only been up for a few hours. It's a question of the week, so it'll run all week. If you haven't had a chance to vote yet, listeners, go up to our @options handle on Twitter. Make your voices heard there in the old chat room. Jerry Pena chiming in our Mixlr chat room saying, it makes no sense. Derivatives should be treated the same as everything else. I think we're with you there, Jerry, on that one. I think all of us see the benefits of, for the very least, buying a put on a stock. Maybe you've held a long time in your IRA, don't really want to sell it yet, but you want to hedge that downside risk. Well, buying a put makes a heck of a lot of sense. Selling a call against that portfolio to juice some extra income. These are all very normal, very risk mitigating, not risk additive use cases for options in an IRA. And yet if the language is the way it stands now, that will indeed be prohibited. Moving on really quickly, this interesting question. This one came from FlyGuy. We actually discussed it a bit, Dan and I, on our Options Bootcamp program. I thought it'd be good to discuss it here as well. I don't think you guys had a chance to discuss it last week, Andrew. Correct me if I am indeed mistaken. But he wants to know, is it possible really to day trade options effectively? Is that really a good use case for options, or is that kind of our options more of a bit of a longer term type trade? I think, again, this is something that Dan and I really sunk our teeth into on the recent episode of Options Bootcamp. Just went up on the network, so if you want to check out my takes on that, go to that Options Bootcamp episode. But we got a few minutes here, so I'll let you guys weigh in. Maybe we'll start with you, Uncle Mike. What's your take on day trading options versus some of the more longer term? Again, by long term, it could be a week, a month. It doesn't have to be 2 years.
Well, I mean, I've day traded options before, but typically never by choice. So in other words, let's say that I sold a put spread and then the stock really goes my way that same day, then I'll get out of the put spread for 90% of the credit with which I took in. So that's probably the only time with which I would day trade options, or if it would go the other way. But in terms of if you're looking to day trade from the onset, it's difficult to do because of the fact that, number one, spreads are a little bit wider in a lot of underlyings and options. Now, if you're doing it on the SPY or the Qs, you can probably get away with it, but it's difficult. You don't have a lot of edge in it. The other thing with which I would mention is that if you have an account with less than $25,000 in it, if you, after a week, you're going to be flagged as a pattern day trader and you're not going to be allowed to do it anymore. So that's the other thing with which to consider. So I'm typically not a fan of it. If you're going to day trade, I say just open up a futures account and do it with the futures.
Yeah, I think actually that FlyGuy guy, I think he does come from, some of the hits I do over there in the Top Step trader chat room, which they are mostly futures guys. So that wouldn't surprise me if he comes from that neck of the woods. So looking at an underlying perspective, I can see where they come from. A lot of people come from the stock world, come from the futures world, the Delta One world, where it is very much an intraday type of game. But a lot of the things we talk about on this show, we talk about the more advanced, complex spreads and things like volatility and time decay. In the case of time decay, it literally has time in the name there. It needs time for that to play out in your favor. How many times have people written to us on this show saying, hey, I bought this great spread, the underlying gap my way the next day, and I didn't really make as much as I thought? And yeah, the answer is yeah. That's kind of how spreads work. It takes time for them to widen out to that level that you need them to be. And if it happens really quickly, it doesn't always work in your favor. So yeah, that's kind of the challenge. Mr. Rock Lobster, you have a lot of chatties and mentees over there at the Option Pit and in your chat room. What do you tell those folks when they come to you looking to sling some options intraday?
Most of the option, and again, unless it's like a fortuitous luck thing, most of the option trades are really not one-day trades. We do have guys that trade futures that are pretty good at it, but if they want Delta One, they just trade futures. Options are more, they're actually kind of the opposite. You don't want Delta One. You sort of want a trade that is a little less directionless and a little more, or a little less direction oriented and a little more, let's just call it decay oriented.
I don't know. All my trades are directionless, so they all just fly around hither and yon, sir. And who knows? Who needs that direction when you can just be directionless? I like that. But you're right. These things do require a little bit of time. That said, there is the focus of the options industry has very much turned towards the shorter term. We're seeing a lot more love for weeklies. We said it many times. SIBO just adding the Wednesday weeklies, so it's not going to be long until we have essentially a strip of weeklies firing off every day of the week and expiring every day of the week. So that effectively brings a daily into consideration. It'll be interesting to see how those perform, particularly in that final 24-hour period where it's pretty much just all gamma all the time at that point. So that'll be interesting to see how those perform, what use case people adopt for them, if it is still all selling, or if people do tend to buy them, and some of the other use cases for them. But yeah, still, even with the love of the weeklies, I think weekly is about as or at least a couple of days is about as sure as a lot of people tend to think when they're slinging options. Good old Jerry in the chat room here mentions the fees, the commissions also are an issue when you're going to sling intraday, and that is true. Options still aren't the cheapest vehicle around when you're slinging them back and forth intraday in particular, and people are used to getting all the stock they want for like $3.95 a trade. It doesn't really work that way yet with options because there's a lot of other things that go into those trades. So from a cost perspective, not the easiest thing to do either. So a lot of reasons why people tend to keep it a little bit longer term, at least a couple of days, if not a week, when you're talking options versus intraday for that Delta One stuff like futures and stocks. Great questions. Now we got to keep on rolling into our final segment, Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, this is the segment, like the man says, where we tell you what we're keeping an eye on for the rest of this week. And as let's finish it up here with another check-in on that mega market mover known as Shake Shack, off now about $3.73 or nearly 9%. So starting to catch up. Like I said, it was pricing in at the top of the show here. It was pricing in, I think, about an 11% move or so. Yeah, it was pricing in, about $4.50. So closing in on that movement here into the after hours. We'll see how it opens up tomorrow. Well, that said, a lot of other things on the horizon for this week. We'll start in the realm of St. Charles. Uncle Mike, what are you keeping an eye on for the rest of this week, sir?
2000. Just waiting, just looking to see. I remember being on this show a couple of years ago when the S&P went up to 2000 the first time, saying, when are we going to get rid of this 2000 magnet? And we're back. The magnet comes back. Curious to see if we go above it or below it. I think we're at a very pivotable time in the marketplace, and I am just laser focused on 2000.
I think you're a pivotable person as well, sir. So
I am pivotable.
Andrew's directionalist. You're pivotable.
Try saying that word after you have mouth surgery.
Yeah, that's true. You had quite the you were on assignment for an extended period last week, but glad to see that you're rallying, sir. And we turn our attention now to the directionless one, Mr. Andrew Giovinazzi. What do you keep an eye on for the rest of this week, sir?
I'm feeling a little directionless. We've got, I think we're not going to do anything until this stupid ECB and stupid negative interest rates. And it's all so sad. I just want these central bankers to go away. They need to go away. They provided liquidity. Then the government, then all the banks paid it back. Now you're done. Now go find something else to do for the next 10 years. And just tell the government to stop spending money like you used to do. I don't get it, but the market's going to sit and wait for Draghi on March 10th. I think everything is a calendar type trade. Until that happens, we're not going to do diddly squat, and we're going to keep watching commodities, metals, and everything else get squeezed up. That's what I'm watching. I don't see a whole lot different happening. There you go.
Unfortunately, that is indeed pretty much what everyone's watching. I think the numbers out there, VIX Cashland and otherwise, kind of reflecting that lack of any movement, at least for the near term. We were hovering much higher levels than we are right now from a vol perspective last week, and non-farm seemed to put the final nail in that coffin towards the end of last week. Who knows what we'll be at the end of this week, but at least for now, a few things to watch in addition to the old Shake Shack. The market mover, that is the shack. That music means it's time for us to wrap up this episode of the Option Block, listeners. But before we go, as always, let me check back in with each of my cohorts here on the old Option Block All-Star panel. See what they have cooking that may interest you. Let's start in the realm of Maine this time. Mr. Rock Lobster, what's cooking in the land of the pit?
We are going to have 2 new Saturday classes, one at the end of March, which will be it'll be an advanced trading seminar on how to actually use diagonal spreads and portfolio margin correctly. And then we will have back to the kind of the vanilla session, but I think a good one, although the Labor Department might outlaw it, so nobody can buy puts anymore. You're all screwed. And thank you, the Labor Department. I wonder if actually anybody writing that law even knows what an option is. But anyway,
it's the Department of Labor, so you're probably right. They have no clue.
It'll be on using puts and longer term options in like in a retirement account or a trading account as a proxy for stock, and trying to learn to do it in a very risk controlled way, but also with a nice risk reward profile as well.
Just not in an IRA, at least not soon. You can do it now, but not perhaps
you
soon.
Just can't do it anymore. Yeah. You can't. Why do that?
What fun would that be? Just let the dice fly high, sir. Let them roll and see what happens. Let the stocks go up, let them go down, and you move with them. That's all. That's how it's supposed to work.
I don't get it. Whatever.
All right. And Uncle Mike, in addition to your umbrage over perhaps the notion of the DOL stripping options out of IRAs, what else is coming down the pike in the land of RCM Wealth Advisors?
Much umbrage on the subject, but Andrew expressed my umbrage good enough for me for today. But I do have much more umbrage. On a happy note, if you are someone who likes to trade options, which if you're listening to this show, you probably are, feel free to contact me about trading them for 35 cents a contract under the RCM umbrella at TD Ameritrade. Because we have many millions of dollars under management, we do get a discounted rate through TD Ameritrade, among other brokers. So if that's something with which you're interested in, we're happy to pass on the savings to you. And we do charge a small fee for the service, but it's typically very nominal. But if that's something with which you have interest, feel free to contact me at mtosaw@rcmfs.com or at 312-212-3531. Thank you very much.
There you go, listeners. Hit them up if you are indeed so inclined. Even if you're not, hit them up. Tell them thanks for giving us all this fun info on the old program. And on behalf of Uncle Mike and the Rock Lobster, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing to the show, for sending in such great questions. Keep them coming. We'll get to them on Thursday. And, of course, for the growing number of you who are listening live, I know it's kind of hard with our schedules changing all the time, but if you stay tuned on Mondays and Thursdays, 3 p.m. Central, 4 p.m. Eastern, we're going to try to have, definitely this week, we're going to try to keep it up next week for you, too, even though I'll be traveling hither and yon, traveling quite a bit in the next few months. But that said, we'll try to keep the live stream going for you. So bookmark this Mixlr chat room here every Mondays and Thursday, 3 p.m. Central, 4 p.m. Eastern. Friday for Vol Views, 12 p.m. Central, 1 p.m. Eastern. And we'll try to get the live streams out there for you. Of course, you can find them all on demand, wherever you find your favorite podcast programs. And we'll see you next time for more The Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.